People today are living longer and longer lives. In fact, Hallmark Cards reported that in 1 year alone, they had sold more than 100,000 happy 100th birthday cards. The Wall Street Journal, in a July 2006 article, said that studies have shown that with a 65-year-old married couple, there is a 67% chance that at least one of them will live to age 85 and a 42% chance that at least one of them will live into their 90s. This longevity is, of course, both a blessing and an opportunity to live more, dream more, accomplish more than previous generations would have ever thought possible. But with this blessing comes a challenge. The challenge being to make sure that your money lives as long as you do. Hello, my name is Shawn Moran, the founder and president of Westport Insurance Group in Charleston, West Virginia, a company that exists to help you make sure that you do not outlive your money. One tool that can be used to help make sure the money lasts is an annuity. The Wharton Business School has published a paper finding that properly used, an income-producing annuity can be a very important component in a retirement distribution plan that is built to last. Annuities are effectively life insurance in reverse. We purchase life insurance in case we do not live long enough to provide for those we love. We purchase annuities in case we live too long to provide for ourselves. I will focus my time with you today on fixed annuities, specifically 3 types of fixed annuities. There are immediate annuities, fixed interest annuities, and fixed indexed annuities. An immediate annuity is one in which you pay a lump sum to an insurance company and they immediately begin to pay you a set amount of income for a specified period of years or for the rest of your life. The upside of this type of annuity is that it can create a very reliable source of income that can, if the money used to purchase it is non-qualified money, be tax advantaged due to something called an exclusion ratio. The downside is that you lose control of the lump sum that you gave the insurance company, effectively having traded an asset for an income stream. The second type of fixed annuity is a fixed interest annuity. With this type of annuity, you are paid a declared fixed interest rate for a specified number of years. The interest can grow tax-deferred until you decide to take it out at the end of the term or with penalty-free withdrawals during the term. The downside is that you are committing your money to that specified period of time. These are, after all, long-term products, and there would be surrender charges applied if you cashed out early or took out more than the annual penalty-free withdrawal limits specified in your contract. A fixed indexed annuity has the same liquidity considerations of having penalties for cashing out early as a fixed interest annuity, but it is different in that they have a unique way of crediting interest. Instead of declaring an interest rate in advance, your interest each year is credited as a percentage of an outside market index, such as the S&P 500 index. When you open a contract, a record is made as to what that index is when your money is first received. Each year on your anniversary date, an interest calculation is made based upon the movement of that index's value. When the index goes up, you are credited as interest with the gains of that index, not including dividends, up to a predetermined ceiling. That ceiling might be an annual cap, a monthly cap, or a percentage of the overall gain. But the bottom line is that there is no such thing as a free lunch. In return for protections on the downside, you agree to limits on your upside. Whatever interest you earn typically locks in on your anniversary date and cannot be taken away by future market downturns. This agreeing to a ceiling in exchange for a floor can be illustrated by the career of the great baseball player Babe Ruth. Many people know that when he retired, Babe Ruth was the all-time home run king with 714 home runs. But many folks do not know that Babe Ruth was also the all-time leader in strikeouts, having struck out nearly 2 times for every home run he hit. Those who saw Babe Ruth play felt like whenever he swung the bat, it was going to be either a home run or a strikeout. Many people have felt that way about their money in recent years, where they either hit a financial home run during the boom years or struck out, losing money during the bust years. A fixed indexed annuity is a financial product where you agree to give up the home run of making all of the gains in the good years in exchange for protection against market losses during the bad years. Like all annuities, they are for the long-term part of your savings that you would like to help provide for your retirement in a stable manner, but still have some interest-earning potential. Like all financial products, you don't want to put all of your eggs into an annuity basket, and you want to make sure you do your homework very carefully before purchasing. One excellent guide that can help you determine their suitability for you is the Buyer's Guide to Fixed Deferred Annuities from the National Association of Insurance Commissioners. Call my office and I will be happy to send you a copy. Whether you own annuities that you have not had professionally reviewed in a long time, or whether you are considering annuities as a part of your retirement planning, give my office a call and arrange a time for us to talk. Sometimes a fresh set of eyes and an independent voice can help you to make sure you are on the right track and increase your confidence that no matter how long you live, your money will live just as long as you do, and maybe even longer.